Hi, in this video I'm going to look at two investment terms, market cap and enterprise value. And these are two ways of measuring the value of a company. And I'm going to explain what they mean, and I'm going to show why I think enterprise value is actually the more useful term, even though market cap is probably better known. So I'm going to start by explaining what market cap means. I'm going to use the example of Unilever. So right now, in Unilever, there are 2.84 billion shares in issue. So what that means is if you put all the shares owned by individuals, owned by fund managers, owned by pension funds, all of them, added them all up, you'd have 2.84 billion shares. And just before I started filming this video, the Unilever share price was £24.89. So if we multiply these two together, the share price and the number of shares in issue, we get Unilever's market cap, which is £70.7 billion. So if I was some massive American company that wanted to buy Unilever, I'd need to pay, in theory, I'd need to pay the shareholders £70.7 billion. That's the stock market value of Unilever right now, or the market cap. And market cap, by the way, stands for market capitalization. It's the stock market value of the company. That's fine. Now, enterprise value adds in one extra factor into the equation, and that's Unilever's debt. And the best way to measure debt is net debt. So net debt is when you look at how much debt a company has, short-term debts, long-term debts. You also look at how much cash Unilever has in its bank account. You take the cash away from the debt, you get Unilever's net debt. And in the last published accounts, Unilever's net debt was £9.77 billion. That's the net debt. And actually, if I wanted to buy Unilever, I'd need to pay £70.7 billion to the shareholders, the market cap, but I'd also need to pay off Unilever's creditors. So I'd need to pay off the net debt, which is £9.77 billion. And that's how you get enterprise value, because enterprise value is market cap plus net debt. And so in this example, Unilever's enterprise value is 70.7 plus 9.77, which equals 80.47 billion pounds. So the market cap of Unilever is 70.7. The enterprise value is 80.47. Because if I wanted to buy Unilever, I'd have to pay the 70 billion to the shareholders, the 9.7 billion to the creditors. My total cost would be 80.47 billion. That's the enterprise value. Now, of course, not all companies have net debt. Some companies have more cash than they have debt, so they have net cash rather than net debt. So to look at that in a bit more detail, let's do another example, and we'll do some imaginary companies this time. We're going to do two companies. We're going to call one company A and one company B. And these two companies, they're really similar. They operate in a similar business area, and they both have market cap of £10 billion. They both have 1 billion shares in issue. They both have a £10 share price. And they both made profits last year of £500 million. Which means that the earnings per share is 50p. Now, if you don't know what earnings per share means, we've looked at it in another video on price earnings ratios and earnings per share. I don't have time to look at it now, so if you can go and find the other video, and that will explain what EPS means. So again, exactly the same. They've both got EPS of 50p each. That's just another measure of profit, which means the price earnings ratio is 20 for both companies. And once again, the video on the PE ratios will explain what that all means if you don't know about that. So here up to now, both companies are absolutely identical, and they're even more identical because profit in both companies has been growing at the same rate for the last 5 years. But there's one big difference, and that's in terms of debt and cash. Company A has more debt than cash. Company B has more cash than debt. So company A has net debt of 2 billion. Whereas company B has net cash of 2 billion. So we know to calculate the enterprise value, we say market cap plus net debt. So that's 12 billion, that's 10 billion plus 2 billion gives us an enterprise value of 12 billion pounds. When you've got net cash, you say market cap and you take away the net cash. Now, I know that can seem counterintuitive. It did when I first discovered this concept a few years ago. But think of it this way. If you're buying company B, you have to pay 10 billion to the shareholders. Once you've bought the company, you have 2 billion sitting in the bank account. You can whip that 2 billion out. So the effective cost of buying the company, which is the enterprise value, is 8 billion pounds. But if you're going to buy company A, you pay 10 billion to the shareholders, then you've got to pay off the creditors. So that's another 2 billion. So the enterprise value of the company is 12 billion. And suddenly it's clear that company B here, with a much lower enterprise value, is much cheaper than company A here with a 12 billion enterprise value. And you would never have known that if you just looked at the market cap here, if you just looked at the profits, if you just looked at the price earnings ratio. So that's why I think enterprise value is a really important concept. It really helps you understand better whether a company is cheap or not. And it can help you buy the shares that are really likely to grow and be successful investments, often because they've got healthy cash holdings. In another video, I'm going to look again at enterprise value and see how to compare enterprise value with various measures of profit. But until then, good luck with your investing, and I'll see you next time.